Well, hello class, and welcome to our lecture discussion in Chapter 9 on the topic of financial planning and analysis, the master budget for VACC 531 Managerial Accounting. Hope this video lecture finds each of you doing well as we get started into Chapter 9 and talking about the master budget and all of the components that go into the master budget. One of the key things that I want you to approach this chapter with is an open mind regarding the value and the benefits of a budget. One of the challenges to budgeting in any organization and in any context is that budget tends to be thought of as a bad word. People in an organization often tend to view the budget as something that is constraining, something that's a burden, or something that is just one of those things that has to be done in corporate life. While I understand that perception from an organizational behavior standpoint, nobody likes to be told, well, you can't buy this, you're over budget, you're under budget, you've not performed well according to the budget. We have a natural dislike for those things that tend to hinder us. From an organizational management standpoint, the budget can be a very valuable and a very useful tool. And it can be so in a variety of different ways, as we'll see. One of the most important benefits of using a budget in an organization is simply communication, both communication from those within and without the organization, what we might call lower level managers, mid-level managers, and upper level managers all communicate throughout the budgeting process. And the exchange both of information about what is, information about what needs to be or what should be, and information about how we can get from what is to what should be is all part of the value of a well-done budgeting process. So while budget often has bad connotations, understand that when it is done right and when it is done well, it can be a very valuable and useful tool, and in some cases can even improve employee morale. Again, it just depends upon the particular budgeting situation and how it's approached. But understand that a budget is simply a tool for managers to use in an organization, both for communication, for control, for strategy, and for planning. So keeping that in mind, let's jump in and talk about our first learning objective, which is LO9-1, explain the relationship between between financial planning and analysis and the master budget. So along those lines, when we talk about financial planning and analysis, or commonly abbreviated as FP&A systems, a financial planning and analysis system helps managers assess the company's future and know if they are reaching their performance goals. A complete FP&A system includes subsystems for planning, for measuring and recording results, and for evaluating a performance. When an FP&A system is done right, and when it is organized and set up holistically, it's going to include all three of those critical components. The planning component, as you'll see on the slide, the planning component of an FP&A system is called the master budget. Again, the master budget, budgeting has many benefits, but one of the key purposes and benefits of a budget is the facilitation of planning for an organization and its various divisions and components. The master budget in the context of an FP&A system is intended to help ensure that plans are consistent and yield a result that makes sense for the organization. Next up is Learning Objective 9.2, list and explain 5 purposes of budgeting. So when we talk about the purposes of budgeting, as I mentioned in opening, the purposes connect with the benefits, the advantages of budgeting. Of course, we wouldn't do it or we wouldn't seek out the budget as a process in an organization unless there were certain advantages to be realized from that process. As many and realistically, all of you who have been part of a management role in an organization are aware, if you've had budget responsibilities, the budget can be a very time-consuming and focus and energy-consuming effort on the part of an organization. So it's very important, if we're going to budget, that not only do we budget well, but in seeking to budget well, that we understand the foundational, fundamental purposes of why we budget. What are the purposes of budgeting systems? A budget is defined broadly as a detailed plan expressed in quantitative terms, typically dollar amounts, that specifies how resources will be acquired and used during a specified period of time. Now, when I say typically dollar amounts, generally the end budget, the actual end product that we're creating, most of the time is going to be expressed in dollars or in some unit of currency. If you are an international firm that uses a different currency basis, it will typically be expressed in the currency basis that that organization typically uses. However, as we'll see going forward, it's important to realize that budgets are not always based on currency. A budget can be based on units of product or volumes of product, or units or volumes of raw materials and other resources to be acquired. There's a variety of different ways we can approach it, but what is universal in essence is that a budget is going to be quantitative in some way or form. Now, there's qualitative information there too, as we'll see, but the key components of the budget are going to be quantitative in orientation, whether we're dealing with units or whether we're dealing with dollars. So having said that, the 5 broad purposes of a budgeting system, these are not exhaustive, but these are 5 broad, generally accepted purposes behind budgeting, are first, planning. Secondly, facilitating communication and coordination throughout the organization. 3, allocating resources throughout the organization. 4, controlling profit and operations. And 5, evaluating performance and providing incentives. Having said this, I want to bring to your attention what a world would look like in terms of a large, complex corporate organization without a budget. Imagine for a moment, I often tell my freshman managerial accounting or intro managerial accounting freshman students at the undergraduate level, imagine for a moment that you come into an organization as CEO, and let's say that that organization happens to be Apple or Microsoft, very, very large, complex corporate organizations that have a worldwide impact and a worldwide focus to their businesses. Let's imagine you come into the role of being the CEO or the CFO, as the case may be. Let's assume for a moment you're the CEO, the Chief Executive Officer, and you have, in essence, a blank checkbook. You have all this money, all the financial resources of your firm, but you have no idea how to spend it, where to spend it, or what needs to be done with it. If you don't have a budget, you may have an enormous checkbook, but you may be absolutely clueless as to how to invest that checkbook. And beyond just simply cash in bank, all of you will be aware that an organization as large and complex as those entities is going to have a wide array of financial resources and assets to its credit that goes far beyond just simply cash in bank. Cash in bank's important, but there's also a very large balance sheet in a number of respects, and it is up to you as the CEO to ultimately decide how those resources should be used strategically in your firm. If you have no budget, then you have no plan. And if you don't involve your organization, particularly your leaders in your organization who know their divisions, and then those underneath them who know their separate segments of those operating divisions, if you don't involve them in the process, then in essence what you're doing is making arbitrary and, in the majority of cases, naturally ill-informed decisions. One person, no matter how experienced, cannot lock themselves in a proverbial closet and expect to budget for an organization that's that complex and that involves that many concerns and people and moving pieces to the business operation. What is required is a system of communication, the ability to set priorities through that communication, and then to allocate financial resources according to those priorities and according to the overall vision for the organization. Budgeting, expressed in all of these 5 purposes, is the process that facilitates that and allows that to happen. So broadly defined, the budget process is a critically important process for virtually every organization. In terms of the broad types, or what some will call categories of budgets, there are 4 that we're going to look at predominantly. The master budget is the budget that encompasses and covers all phases of a company's operations. In essence, it's the great big end summary document. Once all budgets for all divisions and all parts of the business process for an organization are brought together for a specific period of time, that's going to result in the master budget. But as you can see on the screen before you, the master budget composes several other detailed budgets, or what some would call subsidiary budgets. For example, we have a sales budget. That is how we, by the way, start the budgeting process. If you have no idea how many products you expect to sell, then you don't know how many products you need to make, and you don't know how to allocate resources throughout your business organization organization in order to facilitate the making of those products. The sales budget and the sales process is where the budgeting process will in fact begin. In addition to the sales budget, there is also a production budget. Now, in complex organizations, that's typically a series of budgets. Uh, very often you'll find a production budget for each major product line, or in some cases for each individual product that's manufactured in an organization. But broadly defined, the production budget is the detailed budget that's going to encompass all of the budgeted plans and the budgeted resources in order to produce the products or facilitate the services that will generate sales for the sales budget. And then, as a subsidiary component to the production budget, there is the materials budget. Materials is critical for any organization, even service organizations that require resources to facilitate the services they provide. When we think about a manufacturing firm, obviously raw materials and the use of materials, whether they're purchased already with some of the manufacturing done, component parts or things of that nature, or whether they're raw materials, things like steel or rubber or a wide variety of other materials that are the raw ingredients that go into a manufacturing process. The acquisition of materials and the planning for the acquisition of materials is a critical part of the business operation of a manufacturing firm. Very often the materials budget will end up being what, to use a common expression, will make or break the business organization. If the business organization overshoots the budget for materials, meaning they spend too much money or have too much unplanned expense in the acquisition of materials, that can cause everything else to be jeopardized from that point on in terms of profit planning and profit management. So the materials budget is critically important as well. To digress back to my point on service businesses, even if you are not really in the business of manufacturing, you're in the business of providing a service, there will be materials that will need, in most cases, to be acquired in order to facilitate that service. For example, in a public accounting firm, largely the value that accountants are providing is either the creation of a tax return, the issuing of an audit opinion, or in the case of CPA firms, public accounting firms that do a lot of consulting business, it is the advice and the counsel of the CPA as a consummate business professional. Those types of things are not very intensive with regard to material. Primarily, the product of a public accounting firm is going to be the knowledge and the expertise of the accountant or accountants who operate within the boundaries of that firm. But even in that situation where predominantly it's knowledge and expertise that's driving the service, there are certain materials that will need to be required or need to be acquired in the course of business. If you're going to provide digital services for clients, or realistically, if you're going to operate in the 21st century in providing public accounting services, you're going to need to acquire technology in various forms. That can include, of course, computers, PCs, but it can also include tablets, cell phones, printers in some cases, and of course, if you're going to provide paper products, for example, a printed tax return or a printed audit opinion, which is typically furnished, then you're going to need a printing service or have a printer on site that can provide those end work products. But my point is that even in the context of a service organization or service business where the primary product that's being furnished is knowledge and expertise, there are still incidental materials that will need to be required. Those materials need to be budgeted within the organization so that, again, planning, control, and proper control of end profit as well as management of expenses can be facilitated through the budgeting process. Budgets also give us the ability to create what we call pro forma statements. When we talk about pro forma financial statements, it's important to realize that these are financial statements which are not actually the end result of a particular period of time or that it result from a situation in which we have the passage of time and the operations of a business that give us realistic financial results or that give us the results of a period of operations. Pro forma financial statements are in essence projecting into the future, looking at a future period of time and trying to determine, okay, If we're going to project our financial statement over the coming year, what do we expect our sales to be? What can we expect our expenses to be? And then at the end, what can we accordingly expect our net income to be? Pro forma financial statements often capture the attention of managers because they give managers an ability to look into the future and to plan and make decisions on that basis. If we know that due to some unexpected increase in expenses for the year due to natural disasters or due to the incurring of expenses that were not originally planned on, we're going to have less income, it's important for managers to know that. For example, at the time of this particular lecture's recording, we are journeying through the COVID-19 crisis in the year 2020. And in the course of journeying through that particular crisis, or the crisis that not only our area of the country, but the entire country and the world has been journeying through, companies are having to face a variety of expenses that let's say even 6, 7, 8 months ago, they had no idea, no inkling they would be facing at this point. The costs of checking temperatures and furnishing masks and personal protective equipment and trying to do daily cleaning and sanitation at the level that's necessary in order to furnish a clean, safe, and healthy work environment for employees is a considerable cost that has to be factored into the plans of a business organization. While it might be tempting to think from just a human standpoint, well, yes, of course we'll do those things. We'll figure out how to make it work, and that's the right sentiment. But the reality is, each of you will be aware as managers, is that we'll figure out how to make it work idea has to be put into action some way or another. The question is, how are we going to make it work? And the use of budgets and the pro forma financial statements they can lead to help us in the course of figuring out how we'll make it work and what decisions will be necessary in order to make that work. So that's one example among many that we could look at. But pro forma financial statements are those projected financial statements or estimated statements that help us to plan for those things and figure out what will the likely position of our firm be given this set of assumptions and given our current operating plans. So pro forma financial statements can result in a pro forma income statement, a pro forma balance sheet, and a pro forma statement of cash flows. Together, these constitute the primary budgeted financial statements that we'll look at and turn our attention to throughout the balance of the chapter. Long-range budgets. As you're aware, long-range budgets are exactly what they sound like, and that is that they are long-range in orientation. Short-range budgets, or what we call current budgets, are budgets typically that are established for the next 12 months within a one-year period of time. For those of you who have an accounting background, you'll understand that the difference between current and non-current is generally established as a 12-month period of time, or the operating cycle of the business, whichever is longer. That same assumption is what we apply in terms of drawing the distinction between long-range budgets and shorter range or current budgets. So you'll see on the graphical representation before you a timeline, and that timeline runs from 2017 to 2020 in this example. Let's assume that we are at point 2017, that's the current year, and we're looking at the time period represented on the timeline between 2017 and 2018. In this scenario, that would be a current or a short-term budget. This budget, what we call a continuous or often a rolling budget, is typically a 12-month budget that rolls forward 1 month at a time as the current month is completed. Many firms like the attraction or they like the value of a continuous budget because it enables you to be constantly updating the budgeted process. For example, let's say we move from July into August. If that's the case, then when we elapse the month of July, we reach July 31st, and thus the end of that period, we will remove that month from our budget. We now journey through it, so that no longer is budgeted data. What we have is historical data that we'll compare to what we had budgeted. And then we will add on the next month, let's say July of 2021 or August of 2021. As we deal with a continuous or rolling budget, every time we get through the balance of a month, we're going to add on another month so that we always have a 1-year rolling projection or 1-year rolling budget process that we can look at and use for planning purposes. The advantage to this is that the budgeting process is always kept current because we're always doing it. We're always adding on that next month to the continuous process. The disadvantage, however, as you can likely see already, is that results in a situation in which a lot of time and energy is constantly being plowed into the budget. Rather than creating an annual budget and doing that as an annual process where the budget may consume our attention, our focus for a particular period of time, and then we move on to other things, in a continuous budget, we're in essence, always budgeting. We're always projecting, trying to figure out, okay, what needs to be in the next month that we're going to add, and how will we need to adapt or adjust the next 12 months budget, and what will we need to look at further into the future. With regard to long-range budgets, these are budgets that have a time horizon that goes beyond a 1-month period of time. As you'll see at the top of this slide, an example that is commonly used in business organizations is the capital budget. Capital budgets deal with the acquisitions of a business that typically are going to involve several years in terms of their period of time. When we invest in capital or long-term assets, typically those assets are going to last beyond a 1-year period. For example, if a firm invests in a new server, or if they buy land or construct a new building or purchase vehicles for the service fleet that serves an organization, all of those are going to, in the vast majority of cases, be investments that will last longer than a 1-year period of time, and thus they would be appropriate for treatment on the capital budget of an organization. Capital budgets not only represent the investment of resources, financial resources, in the acquisition of capital. Capital budgets often involve schedules of depreciation, looking at the depreciation costs that will result from the acquisition of those resources, which needs to be planned and managed on the part of the business as well. Financial budgets are those budgets in which we look at financial resource acquisitions and the use of those financial resources in a firm's operations. Learning Objective 9-3. Describe the similarities and differences in the operational budgets prepared by manufacturers, service industry firms, merchandisers, and nonprofit organizations. So in terms of the components of a master budget, as you can see on the slide, this is a complex web. One thing I would tell you in opening here, don't get overwhelmed by what you see. As I have often said throughout our managerial accounting journey in prior video lectures, remember to take this one step at a time, look at it one piece at a time. In essence here, we're really dealing with 3 broad groups of budget. You'll see at the top, shaded in blue, is the sales budget or the services or goods budget, whatever the case may be. Typically, that's going to be the sales budget that we're looking at. And then in green, we have the operating budgets of the organization. And then, of course, in brown, we have the pro forma financial statements that will result, those being the budgeted income statement, the budgeted balance sheet, and the budgeted statement of cash flows. Notice that the sales or services or goods budget, as the case may be, typically, again, the sales of services or the sales of goods budget is what we're going to be looking at for the sales budget. This budget is going to form the foundation for all of the other budget pieces. Notice it starts at the top, and information from the sales budget will flow into, first, the production budget. You'll see in green below that. You'll also see there's an arrow traveling from the sales budget to the cash budget, to the budgeted income statement, and to the selling and administrative budget. The sales budget informs all of these other budget entities because in order to create those components, we have to have some idea of how much we're planning or projecting to sell. You really can't project your cash for the year if you have no idea how much you expect in terms of proceeds from sales, so we must begin with the sales budget before we can create the cash budget, so on and so forth. Beginning with the production budget underneath sales, you'll also see that the production budget, data from that, informs the ending inventory budget, the direct materials, direct labor, overhead, all of the manufacturing budgets that are going to be involved with the production process are going to be tied to and components of the production budget. In addition to that, you'll see, of course, that the selling and administrative budget, while not connected to the production budget, is sort of parallel in terms of its orientation, where it falls in the budget process. And then, of course, these components are used to inform the cash budget and ultimately to produce the pro forma financial statements. The key thing that I want you to take away from this slide is not a memorization of every component piece of the budgeting process. Now, if you're an accountant or a controller, you're going to need strong familiarity with each of these components, of course. But as managers in an organization, what you do need to understand is the nature of the budgeting process, the fact that it involves a number of different pieces, and that for managers, there's value in each of these pieces in terms of informing you and communicating throughout the organization, again, plans, priorities, and the availability and use of resources. All of these are important things that underlie this budgeting process and that are summarized in each of these budgeted components. Financing budgets. When we talk about financing budgets, there are primarily two budgets that we're going to be looking at, that being the cash receipts budget and then the cash disbursements budget, excuse me. The cash receipts budget provides information about cash inflows to the organization. This budget considers things such as the timing of sales and collections, collection patterns, sales that will never be collected, what we refer to broadly as bad debt or bad debt expense. In contrast, the cash disbursements budget portrays the spending plans of the organization, specifically with regard to the use of cash, based on other budgets that are prepared. So cash receipts and cash disbursements are the two broad financing budgets that we refer to. Learning Objective 9.4. Explain the concept of activity-based budgeting and the logic it brings to the budgeting process. Activity-based costing, what we've studied previously is ABC systems versus activity-based budgeting. In essence, what we're doing here is we're applying activity-based costing principles in the context of the budgeting process. With regard to activity-based costing, you'll see that we look at resources, activities of the organization, and then we assign the cost objects or the resources and use of resources in an organization according to those activity cost pools. Cost objects include products and services produced and customers served as a general endpoint. With regard to activity-based budgeting, we forecast the products and services to be produced or the customers to be served. Then we determine what activities will be driven by those particular forecasts, what pools of activity we need, and the metrics, the data that goes with those planned activities and their usage. And then that informs the resources that need to be acquired in order to facilitate that particular level or that plan for manufacturing. So in like manner to the activity-based costing system, where in essence we're trying to drill down into as much detail as possible with regard to overhead or indirect costs, that same principle applies with regard to activity-based budgeting. It's sort of in reverse. We're forecasting, beginning with forecast of products or services that need to be provided, looking at activities in light of that, and then making a determination with regard to budgeted resources. Learning Objectives 9.5 and 9.6. Prepare each of the budget schedules that make up the master budget in a non-manufacturing firm and that exist in manufacturing budgets as well. Prepare the additional master budget schedules required by a manufacturing firm. That'll be LO 9-6. So let's begin by looking at the sales budget. Assume the following as an illustration. Breakers Incorporated is preparing budgets for the quarter ending June 30th. Budgeted sales for the next 5 months are as follows. For April, we have a budgeted 20,000 units. For May, we budget 50,000 units. For June, we have 30,000 units budgeted. For July, we have 25,000 units budgeted. And then for August, we have 15,000 units budgeted. Assume that the selling price per unit is $10 per unit. With those assumptions, we can then move forward and create the sales budget as a result. This will look as follows. We have a column for each of the months in question. Notice we're presenting April, May, June, and then we have a quarter summary. Then we begin by budgeted sales in units listed first. Of course, we have the appropriate units of projected sales for each month, 20,000 for April, 50 for May, and 30 for June. Then we have the selling price per unit listed for each month. Because we do not project any change or any anticipated change in selling price, that will remain the same across all 3 months in the quarter. Then we can, of course, multiply the budgeted sales in units by the budgeted unit selling price in order to determine total revenue per month. For April, projected revenue or sales budgeted revenue will be $200,000. For May, it'll be $500,000, and for June, it will be $300,000, resulting in a budgeted $1 million of sales for that quarter. Now we can move forward into the production budget. Again, remember, we begin with the sales budget and then we move on to the production budget and its various components. Assume the following. The management of Breakers Incorporated wants ending inventory to be equal to 20% of the following month's budgeted sales in units. Further assume that on March 31st, 4,000 units were on hand, and accordingly, we can use this information to prepare the firm's production budget for this quarter. So to look at this as an example, now again, don't be bothered by the fact that you can't see the next 2 months in the quarter. I want to focus in on April as an illustration here with this supporting information. We have in April sales in units, 20,000 units for April, and that is carried over directly from the sales budget we just looked at. Then we're going to add to that the desired ending inventory amount. In order to determine that, remember our 20% assumption we looked at on the immediate previous slide. So we have May sales of 50,000 units, again, that coming from the sales budget. The desired percentage we want to have in ending inventory in April to help facilitate that is 20% of that value, which means that we need to have 10,000 units in ending inventory at the end of April. We add that to the projected sales budget for April of 20,000 because in order to make that principle work, we're going to have to manufacture all 20,000 units we plan to sell in April, plus the additional 10,000 we want to have in ending inventory to help with May's budget or May's sales demand. So we add the 10,000 desired ending inventory amount to the 20,000 units budgeted to be sold in April, and that gives us a total amount needed to be produced in April of 30,000 units. Then we subtract from that number the amount of units we already have in beginning inventory. Again, remember on the prior slide, we were told we have 4,000 units in beginning inventory. That difference of 26,000 units gives us the number of units that will need to be produced for the month of April. That same principle can be applied for each of the months in the quarter, again, using those assumptions, the data from the sales budget, and then using the assumptions we looked at on the previous slide. Together, that will give us the amount or the number of units that need to be produced for each of those months. And as you can see at the bottom right hand, for the quarter, the total number that will need to be produced is 101,000 units. Now we can move into the direct material budget. And again, direct material is a component of the production budget, the broader production budget. So assume that at breakers, 5 pounds of material required per unit of product. Management wants materials on hand at the end of each month equal to 10% of the following month's production. So again, we're seeing that 10% carryover principle applied here as well. Further assume that on March 31st, 13,000 pounds of material are on hand and the material cost is 40 cents per pound. Let's prepare the direct materials budget with that data and that information. So the direct materials budget will look as follows. Again, we have the 3 months of the quarter listed, April, May, and June, with a quarter summary. Notice we begin again with production in units, this coming from the prior production budget. Notice that's not the same as the sales budget. This time we're using the number that need to be produced or manufactured for each month because that's going to drive the amount of direct material we will need to acquire. That comes from the production budget. So beginning with April and looking at the April amount, we have 26,000 units to produce in April. We have materials per unit required of 5, what was our unit of material again? 5 pounds. 5 pounds of material per unit. So we'll go back. We need 5 pounds of material per unit, and we have 26,000 units to be produced. So we have 130,000 pounds of material that will need to be utilized for the month of April. We add to that number the desired ending inventory, again remembering that we want to have at least 10% in ending inventory to meet the next month's needs. So 10% is of the following month's manufacturing needs will be $23,000. We can of course look for May. We have production needs for the month of May of 230,000 pounds of material. 10% of that will be 23,000 pounds that we need for April. That will give us the total amount of material that we need to acquire of 153,000 pounds. We deduct from that, however, the amount that we have in beginning inventory. That's the amount that we already have on hand of 13,000 pounds, which means the volume of materials we will actually need to purchase will be 140,000 pounds for the month of April. We'll carry that same calculation, that same principle, or those same principles over to the following months, and that will give us the data, the budgeted materials data for April, May, and June, and then of course we can summarize that across to get the total for the quarter as well. You'll see noted here that with regard to July production, we can do some projection also using June's data. Even though June is the last month we're looking at here, just understand we can carry over that same calculation in order to make a projection for July's amount as well. For the direct labor budget, assume the following. At breakers, each unit of product requires 0.1 hours, or 1/10 of an hour, of direct labor. The company has a no layoff policy so that all employees will be paid for 40 hours of work each week. In exchange for the no layoff policy, workers agreed to a wage rate of $8 per hour regardless of the hours worked. There's no overtime pay. Again, this is just an assumption example. For the next 3 months, the direct labor workforce will be paid a minimum of 3,000 hours per month as a result. Using that information, let's prepare the direct labor budget. So for the direct labor budget, again, you'll see our 3 months and our 3 columns. We have as the beginning the production in units, and that comes once again from the production budget. For April, we had 26,000 units that need to be produced. For the next one, we have the direct labor hours required, which is 0.10 for each unit, and then we can calculate the labor hours required for the month of 2,600 labor hours. Then we have guaranteed labor hours. That comes in at 3,000 based upon the assumptions we had looked at in the prior slide, and thus we have labor hours paid regardless of the actual labor hours worked for April of 3,000. Now notice for May that volume goes up because in May the labor hours required will exceed the guaranteed labor hours to be paid of 3,000. For April it's less, so we're going to have to pay 3,000. Using the wage rate of $8 per hour, accordingly, we can determine total direct labor cost for April to be 24,000. 3,000 labor hours guaranteed paid multiplied by a wage rate of $8 per hour. For May, that math will run the same, but with the assumption that labor hours paid will be 4,600, the higher of the either labor hours required or guaranteed labor hours to be paid. In that case, 4,600 labor hours required is higher, so we will take the 4,600 labor hours to be paid multiplied by the wage rate of $8 for May to get total direct labor cost of 36,800. We'll perform that same process month by month until we get all 3 months budgeted and thus can determine that the quarter total direct labor to be paid will be $84,800. Now we can look at overhead. So here's Breaker's overhead budget for the quarter, and again, this will be based on additional information that will come into the budgeting process, usually on a department-by-department basis. So we have indirect labor projected for all 3 months, indirect material, utilities, rent, insurance, and maintenance, with the corresponding total for each month and the totals for the quarter presented. Selling, general, and administrative expense budget. At Breakers, variable selling and administrative expenses are 50 cents per unit sold. Fixed selling and administrative expenses are $70,000 per month, and the $70,000 of fixed expenses include $10,000 in depreciation expense that does not require a cash outflow for the month. Using that information, we can now look at the selling, general, and administrative expense budget and the process for creating this budget. So we begin once again by taking sales in units from the sales budget this time. Notice that the selling, general, and administrative expense is driven not by the production budget, but by the sales budget. So we begin with the units to be sold each month, and then we have our variable selling and administrative rate to be applied per unit of 50 cents per unit. Thus, we determine variable expense for selling, general, and administrative to be $10,000 for April, $25,000 for May, and $15,000 for June. We then list the fixed selling and administrative expense for each month. That is $70,000 for each month because that $70,000 is fixed in nature, so it's not going to change over the short-term time horizon. And that will give us the total selling, general, and administrative expense that's projected for each month. $80,000 for April, a combination of the variable amount of $10,000 and fixed of $70,000. Likewise, we'll have $95,000 for May and $85,000 for June. We then subtract from that non-cash expenses. There are some expenses that while they are recorded on the books of the firm, they are not cash-based expenses. Great example is depreciation expense. Depreciation expense under generally accepted accounting principles has to be recorded in the books and recognized as a legitimate expense because it represents the consumption of assets in the firm, but depreciation is a non-cash expense. So those types of non-cash expenses will be deducted for purposes of determining cash disbursements. So in April, we projected we'll have $10,000 non-cash expense. We project the same for May and June. That will leave us with cash disbursements amounts of $70,000 for April, $85,000 for May, and $75,000 for June. Combination of $230,000 of cash disbursements projected for the quarter. Now we can use that information to help inform our cash receipts budget. At Breakers, all sales are on account, and the company's collection pattern is as follows. 70% is collected in the month of sale, 25% is typically collected in the month following the sale, and 5% is uncollected and will thus become bad debt expense. The March 31st accounts receivable balance of $30,000 will be collected in full, so assume that as well. Using these assumptions, we can now move forward and create the projected cash receipts budget for the quarter. So we begin by looking again at our 3 columns for our 3 months. For the month of April, let's start there. We had an accounts receivable balance as of the end date of March 31st, of $30,000. That will become our opening accounts receivable balance for the month of April. Then we have April sales. We know that we had $200,000 projected in sales dollars for the month of April, that coming from the sales budget. If we project 70% of that sales dollar amount to be collected in April, we need to plan to receive in cash $140,000 in the month of April. That again being $200,000 of April sales multiplied by 70%. However, the remaining 25%, excluding the 5% that will be uncollectible, will be, as we saw in the prior slide, collected in the following month. So 25% of $200,000 of April sales is going to be $50,000. We will plan to collect that in May, and you'll see the cash amount for the cash receipts associated with that listed appropriately in May's column. We can then move forward down to the total for the month of April, and you'll see in the April column, total cash collections are projected to be $170,000. Combination of the AR balance for the end of March that we expect to collect in full and the April sales amount we expect to collect in April of $140,000. We then come to May and recognize, of course, we have April sales to be collected in May in cash of $50,000. We add to that the 70% of May's projected dollar amount of sales of $500,000. 70% of $500,000 is $350,000, and that combination will give us the May cash receipts amount that we'll expect. $350,000 of May sales to be collected in May plus $50,000 of April sales to be collected in May gives us a combined total of $400,000. We'll repeat that process for each month in the budget, in this case, each month in the quarter, so we would do June's as well. And we'll have the corresponding projected cash receipts total for each month, and then the total, of course, for the quarter also. Next up is the cash disbursements budget. Assume for the cash disbursements budget that Breaker pays 40 cents per pound for its materials. Further assume that 1/2 of a month's purchases are paid for in the month of purchase and the other half is paid in the following month. Also assume that no discounts are available and the March 31st accounts payable balance is $12,000. Using this information, let's perform calculations as follows. For the cash disbursements budget for the quarter in question, let's start with April. We have accounts payable balance to be carried over from March 31st, March ending, which will be April's opening balance of $12,000. We then add to that 50% of April's projected purchases of $56,000. We calculate that by taking 140,000 pounds of material multiplied by the purchase rate of 40 cents per pound, or $56,000. We expect 50% to be paid for in April, 50% to be paid for in May, so we'll list $28,000 in each column as appropriate. And then we can total April's amount, the $12,000 carryover balance from March plus $28,000 of April purchases gives us total projected cash payments for materials of $40,000 for the month of April. We'll likewise perform similar calculations for May and June, and again get the total for the quarter as well as a result. Breakers maintains a 12% open line of credit for $75,000. Further, it maintains a minimum cash balance of $30,000, and it borrows and repays loans on the last day of the month. As you can likely tell at this point, we're looking at cash management, and that's going to inform the creation of the cash budget we'll look at in the next slide. I further assume that Breakers pays a cash dividend of $25,000 in April, and it purchases $143,700 of equipment in May and $48,300 worth of equipment in June, and it paid for those purchases in cash in each month. And finally, assume that it has an April 1st cash balance, that is cash in bank, of $40,000. The cash budget can be created for each month, in this case the month of April, as follows. Notice that in April we have the beginning cash balance that carries over from the cash receipts or from the opening balance, the assumptions on the prior slide, of $40,000. We then add to that cash collections from the cash receipts budget of $170,000, and that gives us total projected cash available for the month of April of $210,000. We then deduct from that a series of cash disbursements, beginning with materials. That comes from the cash disbursements budget. We then deduct $24,000 of cash direct labor payment from the direct labor budget, $56,000 of cash paid for overhead, manufacturing overhead specifically, from the overhead budget. And then we have $70,000 of selling and administrative expenses to be paid, which comes from the selling and administrative expense budget. We then have no item or no amount listed for equipment purchase. Reason being, we didn't purchase any equipment in April. That will change for May and June, of course, but in April we didn't purchase any equipment, so nothing listed there. And then we are told we paid a $25,000 cash dividend in April, so that amount is listed as well, bringing our total cash disbursements for the month of April to $215,000. We can then determine that the excess or deficiency of cash available over disbursements was a $5,000 deficiency of cash, meaning that we took in we're projecting rather that we will take in $210,000 of cash for April, and we're projecting that we will spend $215,000, giving us a $5,000 cash deficiency for the month. Now, bear in mind that doesn't necessarily mean we're going to end up overdrawn for $5,000. There are various sundry things we can do in order to provide the cash that's necessary, typically through the process of taking out short-term loans until we can get an excess of cash in a future month. But understand that knowledge is important because this informs the cash budget, informs how much will need to be taken out in terms of a short-term loan for cash management purposes. So as you'll see noted at the bottom on the right-hand side, to maintain a cash balance of $30,000, Breakers must borrow $35,000 on its line of credit. Combination of the $30,000 minimum balance it wants to maintain plus the $5,000 deficiency of cash it will need to cover expenses for the month of April. You'll see likewise we can perform a similar calculation for May, and for the month of May, Breakers must borrow as a result an additional $13,800 to maintain a cash balance of $30,000. And then finally, we of course will also see calculations for the month of June facilitated as well. Note here that at the end of June, Breakers has enough cash to repay the $48,800 short-term loan plus the interest at 12%. And so at the end of that period, the cash is in hand in order to be able to provide for that. And then, of course, we can calculate our end of quarter summary, or the quarter total summary, rather, for the cash budget. Finally, you'll see interest calculations at the bottom of the screen. The ending cash balance for April is, of course, the beginning May balance, so understand that carries over each month. And also understand that we need to not only plan for the actual dollar amounts of cash needed to cover operations, we also need to plan for the payment of interest on the loan that we've taken out. You'll see interest rate calculations at the bottom of the screen. And, of course, the interest rate calculation in this case is simple. We simply take the 12% annual rate divided by the 12 months that are covered in the year to get the 1% nominal monthly rate to use for calculation. If we're borrowing $35,000 for the month of April, then $35,000 multiplied by the 1% monthly interest rate multiplied by 2 months that loan will be outstanding gives us an interest expense amount of $700. We can perform a similar calculation for other months and other loan amounts as well. I would caution you, however, that while this same basic calculation will typically be what you incur in the calculation of loan interest, most of you are likely already aware that it is fairly rare in practice to find a situation where a loan's interest is calculated on a monthly basis. Typically, loan interest is calculated and compounded daily. It just depends upon the arrangements that are made with the bank in question and the banking system in which you're operating. But however the loan interest is calculated, you as controller or manager, CFO, whatever role you're fulfilling in your organization, if you have responsibility for the cash budget, you will need to be able to utilize that calculation in order to project interest expense for the budget in question and be able to do that accurately. Now we can bring all of this information together to create a schedule for a cost of goods manufactured schedule, or what's often just called the COGM schedule. So in order to create that, you'll see that there's a variety of information presented which comes from the prior budgets we've assembled. We have a direct materials section with beginning material inventory listed for each month. We add to that materials purchases for the month, to get material available for use. We then deduct the ending material inventory amount for each month. Direct material used will be a result. Then we have direct labor and manufacturing overhead to be added to that, giving us total manufacturing costs for each month in question. We then add the beginning work in process inventory to that, getting a subtotal, and then we deduct ending work in process inventory to determine the cost of goods manufactured on a projected or a budgeted basis for each month in question. We can then move forward and use the cost of goods manufactured schedule to create the budgeted cost of goods sold schedule. Now, this is a little simpler, but understand that the information on the cost of goods manufactured schedule informs, along with other sources of information, what we're bringing together on the cost of goods sold schedule. So we have each month listed with its appropriate cost of goods manufactured as the opening line. We add to that beginning finished goods inventory for each month in question, and we get the cost available for sale as a result. We then deduct the ending finished goods inventory for each month in order to determine the cost of goods sold on a pro forma or a budgeted basis for each month in question in the quarter. Now we can use all of that information in combination with the sales budget in order to create a budgeted income statement. Notice that let's assume we're budgeting for the quarter, so this will be the budgeted income statement for the 3 months ended June 30th. We have projected revenue, 100,000 units multiplied by the selling price of $10 per unit, or $1 million. That comes directly from the sales budget we opened with. We then have cost of goods sold for the quarter from the cost of goods sold schedule we just looked at of $460,000, giving us gross margin or gross profit for the quarter of $540,000. We then can deduct operating expenses. We have selling and administrative expenses from prior budget documentation and analysis projected at $260,000, and interest expense from the interest calculation schedule of $838 for the quarter, giving us a combined total operating expenses amount of $260,838. The difference between the gross margin of $540,000 and the total projected operating expenses of $260,838 gives us the projected or the budgeted income amount of $279,162 for the quarter. This together gives us the budgeted or pro forma income statement for the quarter in question. Next up, we can create the budgeted statement of cash flows. I'm not going to go through this exhaustively for each month, but pay attention to what is presented here. Of course, we have our 3 months presented, but notice the types of items presented. We have first cash flows from operating activities, followed by the items that compose cash flows from investing activities toward the lower middle of your screen. And then finally, you'll see cash flows associated with financing activities presented. I often tell my introductory accounting students to remember the organization of the statement of cash flows according to OIF or OIF, operating, investing, and financing. That same principle applies here. It's just a matter that these components of the statement of cash flows, we have the budgeted amounts from the budget, the cash receipts and cash disbursements budgets that we've looked at. We simply bring that information together in order to determine net cash inflows or outflows for each of those items and organize it according to the statement of cash flows, operating, investing, and financing categories. Then we can use this information finally in combination with some other assumptions to create the budgeted balance sheet. So here's those other assumptions we'll need to blend with the prior information. Assume that Breakers reports the following account balances on March 31st prior to preparing its budgeted financial statements for June 30th. We had land of $50,000, net building or building net of depreciation of $148,000, common stock in the amount of $217,000, and a balance in retained earnings of $46,400. Now, we can use that information in combination with previous information to create the budgeted balance sheet for the end of the quarter, that being June 30th. We have first current assets, and you'll see that in current assets we have cash at the end, the projected cash balance at the end of the period of $36,362, followed by accounts receivable calculated as 25% of June sales of $300,000. The reason we know that will be the balance is, remember that we expect 25% of each month's sales to be collected in the following month, so we can project the balance that will remain at the end of June of 25% of June sales to be $75,000. Next up, we have raw materials inventory as of the end of the quarter, $46,000, calculated at 11,500 pounds of inventory at 40 cents per pound. Then we have work in process inventory, $17,000, followed by finished goods inventory of $23,000, calculated at 5,000 units at $4.60 per unit. That gives us a combined total current assets at the end of the quarter of $155,962 budgeted. Then we have property, plant, and equipment, land of $50,000, building of $148,000, and equipment of $192,000 for a combined budgeted property and equipment category of $390,000. The combination of total current assets budgeted for the end of the period of $155,962 and total budgeted property, plant, and equipment at the end of the period of $390,000 gives us total assets budgeted of $545,962. Then we can move from current assets to the liabilities section. So we will have accounts payable listed to $28,400, calculated as 50% of purchases of $56,800. Then we have common stock for the equity section, $217,000, retained earnings of $300,562, and notice the calculation for retained earnings at the bottom left. We have the beginning balance given to us in the opening assumptions of $46,400. We add to that net income for the quarter projected to be $279,162, and we subtract the April dividend we looked at that we paid of $25,000 to get the ending balance projected for retained earnings of $300,562. The combination of total liabilities and equities is accordingly $545,962. That balances with assets, and so our pro forma or budgeted balance sheet balances. Most of you will be aware that the balance sheet is mirrored after the accounting equation, which is assets equals liabilities plus owners or stockholders' equity, as the case may be. If it's a sole proprietorship, we're dealing with owner's equity. If it's a corporation or a corporate type of entity, we're going to be dealing with shareholders or stockholders' equity. But the combination of liabilities and equities has to balance with assets in total in order for the balance sheet to balance. So this is our example for the budgeted, or again, the pro forma balance sheet. Next up, we have learning objective 9.7, discuss the role of assumptions and predictions in budgeting. When interactions of the elements of the master budget are expressed as a set of mathematical relations, it becomes a financial planning model that can be used to answer what-if questions about unknown variables. As you have now seen, each of the components of the budget are intricately tied together, and one component typically informs another component or components of the budget. If the budget is created again along those mathematical relationships, then you can create a system where you can change a certain assumption. For example, the amount of sales that we're projecting to sell. If our projected sales go up or go down by a certain percentage, we can flex the planned budget according to those projections and be able to look at projections or pro forma basis projections on the basis of those what-if assumptions about unknown variables. That can be a very valuable tool, not only in terms of managing what is likely to happen, but managing other possibility scenarios, what we often call contingency planning. So as you can imagine, that can be a very useful tool if the budget is set up along those lines. Learning objective 9.8, describe a typical organization's process of budgeting administration or budget administration. In terms of administering the budget on a continuing basis, typically organizations will utilize what is called the budget committee. The budget committee is a standing committee responsible for overall policy matters relating to the budget and coordinating the preparation of the budget. There are also certain international aspects of budgeting that become important for organizations. Firms with international operations face special problems when preparing a budget. Some of those problems, this is by no means an exhaustive list, but some of the common challenges with regard to preparing budgets for international firms include fluctuations in foreign currency exchange rates, high inflation rates in certain foreign countries, and differences in local economic conditions from one location or one nationality of operation to another. Learning objective 9-9, discuss the behavioral issues inherent to budgeting. In terms of the behavioral impact of budgets, one of the common problems that apply or that come to play when we talk about the use and the creation of budgets is the concept of budgetary slack. This is often referred to as padding the budget, and this is a situation in which people often perceive that their performance will look better in their superiors' eyes if they can beat the budget. Accordingly, they will design or they will try to influence their department's budget in order to facilitate or to make it easier to beat the budget and thus make their performance appear better than it may in fact be. Participative budgeting is one of the aspects of budgeting that can actually increase or improve employee morale in that it involves all levels and all individuals of the organization in the budgeting process. It's often referred to as a bottom-up budgeting process where individual, what we would call first line or front line supervisors, what's sometimes referred to in scholarly literature as low-level managers, those who are supervising on what we might refer to as the front lines, present their budget requirements or their budget proposals to middle management, who then evaluate it, summarize it, and then present the collective budget to top management. Participative budgeting allows all managers and thus all aspects, all sectors of the organization to participate, and have input into the budgeting process. That can be a morale booster because even if the organization is not able to give a particular manager or a particular operating division everything that that manager or division desires, the fact that the manager or the division has a voice in the budgeting process can be valuable both for increasing their participation, buy-in with regard to the budget, and overall employee morale in terms of making employees feel valued and that their contributions are given serious considerations. A top-down budget, in which the budget is created in a more arbitrary fashion by management and then given out to the organization to be followed, has advantages in terms of simplicity and also the ability to very cleanly and neatly keep it within the boundaries of the vision of the organization. If management who sets that vision is creating the budget unilaterally, then obviously the budget that comes out we can expect to be in accordance with that vision, at least if that vision is coordinated with the organization's budget itself. And we would generally assume that to be the case. But it can face challenges in that when that budget is simply issued by top management without the contributions or the participation of middle and lower level management, very often buy-in for that budget can be difficult to achieve. That's a situation in which the budget tends to get a bad rap or has a negative connotation for folks in the organization because it's perceived as something that's forced upon other managers rather than something they have a say in. So participative budgeting from one perspective can be thought of as perhaps a messier process, but it can be valuable both in terms of the communication it provides and the buy-in it can generate and the morale that can result from that. So participative budgeting may be more challenging, in some ways more costly, but in important ways more beneficial for an organization, both in terms of communication and, again, the buy-in it can generate. That's it for our lecture discussion of Chapter 9 on the master budget and the budgeting process. So I want to thank you for taking time to watch this. As always, if you have any questions, you can reach out to me through the contact information provided on the course syllabus and in the My Instructor tab in iLearn. With that, thanks for watching and have a fantastic day.